What's up, everyone, and welcome to the Long Game Podcast hosted by Thomas Kopelman and Jacob Turner. In each episode, you'll hear us break down financial topics that are relevant to you and your situation. Our goal is to help bring credible financial information to you in short, bite-sized episodes.
All opinions expressed on this show are for educational, informational, and entertainment purposes only. Nothing on the Long Game Podcast should be considered advice. Always consult with your team of professionals before making any decisions regarding your finances. What is up, everyone? Welcome back to another episode of the Long Game Podcast. I'm here with my co-host, Thomas Kopelman. And in today's episode, I'm super excited to talk about how business owners should invest. Hashtag not investment advice. But I think this is something, Thomas, that me and you see a lot, right? We both work with business owners, and oftentimes the biggest thing that I see is when I see them breaking out their buckets of money and how they're investing money, it's super concentrated. And oftentimes that's because they own a business, which makes up the large majority of their net worth. So excited to dive into this topic today with you.
Yeah, me too. I think this is a really important topic, and I think there's no right way to do this, right? I think you see the people who basically, like, all the financial advisors who are, quote unquote, like, let's be as compliant as possible, don't have any concentration. Concentration is risk. You should never hold more than 10% of your net worth in any individual thing. And that's just not a reality. Like, you can say that if you work with people who are W-2 employees and they have their 401k and they don't have equity comp. But in all reality, if you work with any highly compensated employee or lead a company or any business owner, there's no way that that's going to happen. And there's two sides of that. One, there's extreme risk, right? If that business blows up, and like, I'm thinking of one of my clients in general, like, they're about 20 million net worth and 17 is in one stock. And it's because it's a really incredible company. They're still private. And he was one of the earliest employees. There is so much risk there. The likelihood this business goes to zero is probably almost at zero at this point, but it is possible. And that would set him back extremely far. But on the flip side of things, his net worth would be about $3 million if he never was at that company. So it can do a lot of things for you. Concentration can build an extreme amount of wealth. And every single person you know with an extreme amount of wealth got there through concentration. On the flip side, if that doesn't work out, you can get to zero or close to zero relatively quickly. So you do need to have strategies in place to be diversified outside of that and at the right times. But I'd love for you to walk through kind of like the three types of investments and the way that you think about it, because I think the philosophy you have is really good.
Yeah, I mean, we break it down into three buckets. So bucket one is really the war chest, which is oftentimes short-term money, cash and bonds at the most, where this is money that we're going to have easily accessible to us. The second bucket, we really break into like the growth strategy, or what I would call the core portfolio. These are things like public, private market investments that are going to be there, that are not taking on substantial amounts of risk, where, hey, we're going to withstand market fluctuation. We know that's going to happen, but we know that most likely these investments aren't going to zero at some point in the future. And then bucket three is really that aspirational bucket strategy. And I would put really any privately held business that you have significant ownership into that category. Venture capital, some private equity investments, I think, can fall into this category. And I think the biggest thing that I often see, Thomas, is when business owners come in, they're either really loaded in bucket 1, 3, or both of those buckets, but they don't have a ton in that core portfolio. And they oftentimes don't think that they're taking on a ton of risk in bucket 3 because they have their hands on it, right? They know it, they can see it. This is all they've ever known. And I think the biggest challenge for us as advisors, specifically to entrepreneurs and business owners, is, like you just said, it is not my job to tell somebody that they should diversify all that risk away, because the reality is, like, how they got wealthy in the first place was by being able to bet on themselves. But it's making sure that they're educated and they're making really calculated decisions around where the money is going next, right? Like, we have all the money in bucket 3. Doesn't mean we need to sell the business, but we just need to understand the risk we are taking.
Yeah. And I think a couple of things. I think one is, at least in my mind, risk isn't only like, what if this goes to zero? And like the risk of diversifying from your company stock or the business that you own is actually that you might miss out on a significant amount of growth. To me, even if that's not traditional risk of volatility, it still is risk that you're missing out on a lot of money by diversifying. So I think we can think about this in a few ways, but I do agree with you that it can be hard to get people to want to diversify, but I think there's also the whole side that it might be impossible to diversify. If you work at a company and you have you've been getting tons of double trigger RSUs, What are you going to do about it? Hey, if you have tons of your compensation through ISOs and that has grown a lot, but it's a private company and you can't sell, what do you do about it? I can't just sell 10% of my business today. Like, I don't know who I would sell it to. So there are times that you cannot diversify out of it. And I think maybe we leave that part out of the conversation. I think the way that we're thinking about this is when you can, right? So maybe you have private stock and you have tender offers, or you have the ability to sell back to the company, or maybe in your individual company that you own, you do have offers, or you could sell to employees, or you could carve out some of those funds, or you could just distribute it, right? Like I have a lot of solo business owners that at the end of the year, like one of the ones I'm thinking, for example, they killed it last year. It was a year we didn't know if they were going to do that well. He ended up with over $1 million in profit, right? After paying himself really well. And the question is, do you pay yourself that? Do you pay yourself some of that? Or do you pay yourself none of that, right? And I think there isn't a for sure good way to look at it, because some of my business owners, the answer, like for me, if that was me, it would be extract that and invest it somewhere else. I have no plans on hiring somebody else. I can't put it into paid marketing. We already have too long of a wait list. So the only real option is I should take that and I should diversify it elsewhere and build wealth in different areas. This business owner, for example, he knows for every dollar he spends on ads, he gets 40 cents in profit. It's a formula he's had for a couple of years. This is where things become a lot harder, right? You buy the product, you put the money in advertising, you have about a 40 cent per dollar profit. That is really hard to tell somebody to diversify from, right? Especially if they have diversified pretty well. And so this came down to, hey, you're early on, you have a bunch of money of investments. We're going to take enough money to pay off your wife's student loans. Let's have you go buy a house. Let's keep the rest of the money, about half of that profit in the business, to continue to spend more money on ads, continue to grow more revenue and profit. And if at the end of the next year, profit is so good, then we're going to do somewhat similar. And we're going to go pay off your 7.5% $1 million+ house in California. And I think for a lot of people, taking money from a business that's growing and put it into public equities can be hard, because when you're viewing investments, right, if you significantly think that'll outperform the alternative, it's going to be hard to say, let's do something different. But if you can extract it and give yourself real life changes, I think that's different. So if you can know, hey, I just paid off a $2 million house, our living expenses went down by $10,000 a month, that actually makes you better equipped to grow a business, right? Because now you can reinvest, or you can invest more money elsewhere, because you barely need to make that much money to live because of what that profit had done for you. And so for me, the easiest way that I found to get people to diversify is by paying off high interest debt, paying off loans, maybe investing in some other things, and doing like the no-brainer private equities of maxing solo 401ks, backdoor Roths, a little bit to taxable account. But taking all of it is kind of hard to convince people to do. And it makes sense to me. I probably wouldn't do that either.
I think the goal that I always think about is you want to create optionality, but this is often where I think good planning comes into play. The best decisions I've ever made always start with the end in mind. And I think it's our job as planners to really ask those questions to business owners that they've never had the questions asked before. Because oftentimes they started the business, they thought, all I want to do is make a little bit of money. Then they started making a little bit of money, and they hired somebody, and they thought, all I want to do is be able to make payroll and not stress about it. And then before they know it, they're 5 or 10 years into this, and they're making really significant money, but they've never really thought about where they want the business to go in the future. All they were trying to do in the first place was create a better life than they had when they were in the W-2 position, or they were thinking about starting this. And now that they've had success, they've never really come up for air to think about, where do I want to be going in the future? And I think ultimately the goal is you want to create optionality, right? I call it throwing money over the wall. If you can throw money over the wall outside of your business, wherever that is, right? Like whether that's in the public markets, whether that's in cash, something outside of your business, it creates a ton of optionality, because then they can come to you in a meeting and they can say, hey, I have this much money over here. I have this much money in the business. If I were to sell the business, here's how much I think I would get. What should we do? And they have really all these different options. They could invest the money back in the business. They could throw more money over the wall. But I think, for you, as you talk about even your own business, you have a clear thought process around what I'm trying to build. I think most business owners don't think about that from a planning perspective soon enough.
Yeah. And I think for me too, the more that I invest outside of my business for a while would actually help me invest into my business later on, right? The better my financial situation is, the less debt I have, the more savings I have, the more investments I have, the more that I could scale back on all of those things. If I flip the switch and say, I do want to hire, I want to grow with more advisors, I want to add, a CPA in house and a bookkeeper and all these other things that'll help me grow my business in the future. But for 1 or 2 years, that would actually take away from what I could pay myself. Well, that's okay because I've set myself up really, really well. But I think kind of going back to this, right? Like when I think about diversifying, I think to me, it is a no-brainer once you hit a certain milestone, right? And that's different for everybody, but it's, the business is running well. You don't have a significant amount of key hires to make. You don't need to spend money on advertising or a new office or whatever. When you're like, hey, I do have extra money and I'm making a lot of money, not for sure, but most likely you should be considering maxing out your 401k, whether that's Roth or traditional, depending on your year income rate age. You should be going back to a Roths. You should probably be doing HSA if you have it. As long as you're doing those and that's how you're diversifying, it's hard to be upset about, $50,000 to $100,000 a year of investments. Maybe then you don't have to take significant amounts more out, but at least you're working on both things at the same time.
Yeah, I think it goes back to like the order of operations. What do you want the order of operations to be when money's coming in? We always talk about you want to give direction to every dollar that's coming in. And much like you talked about, if we're going to be saving money, let's make sure that we're optimizing for taxes, most likely, unless you said like, I want to make sure I have this money to be able to buy a business in the future, right? Yeah. But I think it goes back to like making sure that you have a plan in place. Most of the time, people are kind of flying by the seat of their pants. They start making money and they don't ever think about this sort of stuff until it's too late down the road. And now they have this great business. It's making a lot of money, but they haven't saved a ton. And then what ends up happening is you're 20 years into this and you're thinking, okay, if I sell my business at the right time for the right multiple to the right person with the right exit strategy, I can continue living my lifestyle. And I'm going to tell you right now, like that is the worst possible scenario you can be in because it's one option. You have one option for it to all go right. Versus if you would have been planning for the last 20 years, even if you did exactly what you just talked about, all you were doing is 401k contributions, backdoor Roths, HSAs, simple tax planning, retirement accounts for the last 20 years, you'd be in a completely different financial situation.
I totally agree. I think the other thing I want to hit on here is like, I think sometimes people who are concentrated, most time business owners, or again, kind of the person I was talking about before, lots in a private company, they forget that they actually should be taking less risk outside of that, right? Like when you have so much concentration in one area, you shouldn't be diversifying into 2 cryptocurrencies and then 3 stocks, right? Like you already have so much concentration, so much risk, and then you're going to put so much faith into 4 or 5 different things. That's normally not the way that you want to do it. You typically are going to want to be more in broad-based ETFs, global, etc., because you want something that you can count on. And it's funny, like, 20 years ago or 10 years ago, like all equities or all ETF portfolio is extremely risky. And I feel like now today, like that's a conservative portfolio, and now an aggressive portfolio is significant concentration in a little bit of crypto. But I think it is true. Like you should at least be in diversified ETFs mixed with your concentration here versus gambling on a few stocks that you hope turn out to be really, really well. And the more diversified you are here, the more secure that you can be around that, the more that you can actually take concentration risk on those other things. You just still have to do it wisely.
No, I agree with you. I think the other thing I would say too is for the business owners that are listening out there, I think this goes back to why it's really important. If you're going to hire a financial advisor, to hire somebody who's in your niche, right? Somebody that's dealing with business owners all the time, because it's one thing to talk about the strategies that go with business owners, right? There's a lot of people that can rattle off whatever the tax strategies are, whatever the investment options are for a business owner. But I think it's really important to think about, you want to have somebody on your team that from a psychology standpoint thinks like you think, and they're seeing the same things that you're seeing all the time. Because, Thomas, for me and you, we're seeing this not only in our own business, but we're seeing this with the clients that we're working with. And I see a lot, oftentimes, like the typical financial advisor advice is, oh, well, you're way too concentrated and you should just diversify everything. And look, I'm not going to say that's bad advice. Like diversification is a pillar to investment. It's the only free lunch out there. I totally get it. But at the same time, I think making sure that you're on the same page with whatever your advisory team looks like, and they can understand that like, hey, I'm okay. I'm willing to take on more risk. The biggest thing I think that a good financial advisor can do is they want to educate you around your options. It's not the financial advisor's job or the financial team's job to tell you what to do. It's to give you all the options, to give you the roadmap and say, if we go left, here's the things that we need to be thinking about. And if we go right, here's the things that we need to be thinking about.
Yeah, no, I think that's a great point. And honestly, like I have a new client that I'm working with, husband and wife, both work at very large public companies. They have ESPP, they have RSUs right now. I mean, they are a few million net worth in their early to mid 30s. So like super, super good, but like 60% of their portfolio is in those stocks. But they have so much more stock coming in the future. And their old advisor, all he would tell them every time was sell all of this. Let's move it over to our diversified portfolio. And they just like, it didn't sit right with them. And let's be real, the other person wanted to do that because that's an existing another million that can be added to the portfolio that could be charged on. But they would be paying, call it 100 to 200K in taxes to diversify all of that, right? Mm-hmm. Like a lot of money in tax. When in reality, the best approach for them is in the next 3 to 4 years, just by diversifying the RSUs and the SPP when they vest, we could get you to about 30% of your portfolio in those two stocks. Two incredible companies, two incredible stocks, not too high of concentration in my mind, something that I would do, but it's going to take 3 years and it's not going to add money to be managed by an advisor. And that makes way more sense, right? Why incur and lose so much money in taxes when you could diversify through new equity grants? And it's because like incentives are a problem. And so I think you do need to be working with advisors that understand this and really want to put your best interests in mind and not just say diversify because I know I can't charge you on holding one stock that you own a bunch so we can move to here. And I think this is kind of why advisors get a bad rap in the industry is because a lot of recommendations are tied to more compensation when in reality that might not be the best for that person.
Yeah. The other thing that I would add there too is for the consumers out there, don't be scared to ask the question to the advisor. Like Thomas, in that scenario you just brought up, I think it'd be really important for the consumer in that scenario to say, well, if I kept this stock and worst case scenario happens, what does my financial plan look like then? And again, because this goes back to like, you want to be educated around what your options are. And oftentimes like in their scenario, if they're a couple $1 million net worth, they have steady jobs. Okay, if the 20 or 30% goes away, is it going to hurt? Yeah, it's going to really hurt. But like, is it going to ruin their life? Probably not. And if they're comfortable taking on the risk, then let them take on the risk. It's our job as advisors to educate them. And I think that's the inherent issue with the industry as a whole is I think there's a lot of, I don't know if I would call it narrow-minded thinking, but they're thinking based in a textbook and they're not thinking based in real life. And oftentimes like the best financial decisions are not made in a spreadsheet. The best financial decisions are a combination between strategy, spreadsheet, and real life.
And right at the end of the day, like anybody can read the CFP textbook and say, never hold more than 10%. So you should sell, or, you do this and then do that. But at the end of the day, like that isn't good financial planning. That is literally just putting out the 10 commandments of financial planning to follow. And the 10 things that each person should do is different. The things that you're doing are very different than me, even though we both own a financial planning firm, even though we both make a good income, like you're coming in with different money. You have way more pre-tax money than I do. You have kids, like you have different goals. Like the things that we're going to be doing are entirely different. And that's how personal finance should be looked at. And again, that's how investing should be looked at. A lot of business owners talk to their friends who's, they work at Salesforce and they make $400,000. They're like, oh, they're doing this, so I should do this. And it's like, well, maybe you should be doing something completely different because you have a totally different risk profile and setup than that person does.
Yeah, to piggyback off that point, one of the best lines I heard, and I think it's actually from Dave Ramsey. For those out there that don't like Dave Ramsey, I took Dave Ramsey's Financial Peace University as an 18-year-old. It actually really helps a lot. So hate on Dave Ramsey all you want. But one thing he said, and he was talking about this idea of concentration. And somebody had called in, they asked a question about, I think it was concentration in real estate. And he turned around and he asked him a question about like, well, what is your expertise in? And the person said something to the effect of like real estate. He's like, well, then I don't think you're too concentrated. And I think, Thomas, to your point, oftentimes people are so concerned about doing what somebody else is doing, when in reality, it's not a bad thing that the other person is doing, but it's not the right thing for them. And you make a great point. Like you and I would be willing to bet are some of the more well-educated people out there in terms of personal finance, tax strategies, solutions, investments, things that you can do. And I can all but guarantee that we invest our money slightly differently, that we have a slightly different order of operations. And ultimately, that's because we have different goals in our life. We're at different stages. There's different responsibilities in my life versus your life with kids. all those things change. And it doesn't mean that my strategy is bad and your strategy is good or vice versa. It just means that we're taking all the information we have, the strategies, we're looking at it sometimes in a spreadsheet and saying, well, here's what the numbers say. And then we're looking at our real life and saying, well, based on those other two things, here's the decision that I want to make. But again, we're really educated around what that decision is. And we know, okay, well, here's the pros and cons if I'm going to make that decision.
Totally. Couldn't agree more. I feel like that's probably everything that I wanted to go through. Anything else that you want to add on this topic?
No, I just think I just can't reiterate enough for consumers out there. It is okay to ask questions and to challenge the financial team that you're working with. And if you're not getting the answers that you feel comfortable with, I think it's really helpful to just go get a second opinion. I think oftentimes people are so nervous. They built up a relationship, they built up trust, and I totally get it. But oftentimes you want to have somebody that understands what you're going through, right? Just the strategies are one point of it, but the psychology behind it, making sure that you're working with somebody who's truly a specialist in helping you, I think is really, really important.
Yeah. Couldn't agree more. Awesome. Well, I think that's everything that we wanted to go through today. Everybody, again, we are very appreciative of you following along, listening, and hopefully learning a lot from us. All that we ask is that you leave us a review. Please rate us 5 stars on whatever platform that you listen to. And if you ever have any questions or topic areas that you want us to go through, I mean, we're doing about 52 episodes a year, so we have plenty of room to take suggestions and answer anything that might be helpful. So feel free to message us on Twitter, shoot us an email. But if not, we'll see you back next week.